Well, welcome to this week's market update. In this hour, I think I'll take about an hour, maybe a little bit more than an hour. I'm going to make the bull case for equities. Next week, I will make the bear case for equities. And the reason I want to do this is whenever I observe something in the market that doesn't quite sit well with me, that I can't quite figure out what's going on, I think, well, let's make the case for it. What are all the reasons why equity markets have been as bullish as they are since the Fed turned more hawkish than what the market expected? A lot of it has to do with fund flows, and we're going to look at some fund flows. But what we want to do is not just get taken in by the fact that, as a general rule, this is true, money has to go somewhere. It has to go somewhere. And if it's leaving bond funds, it has to go somewhere. And it's not just in the U.S. Global bonds have been dropping in price for the better part of the last 6-7 weeks. The funds outflow has been huge. It has to go somewhere. But once all that money shifts places, is there any upside left? Have we just really seen a reallocation from bond funds to equities and well, that's it. The buying is done now and the reallocation is done. So we're going to look at the components of GDP, primarily the consumer and investment spending. And we're going to gauge the health of that, because if we are bullish on the market, we have to be bullish on GDP growth. So it starts there. So we'll look at that. Anyways, let's look at our rates for the week. And I've added two more slopes down here because in conversations with somebody in banking, they said what you really want to pay attention to is the 3-month spread against the 5-year and the 10-year, because those slopes are benchmarks for the profitability or the net interest margin for consumer loans and corporate loans. So we had a kind of an odd week. We have the long end of the curve, which yields have given up some of their ground. They've dropped a bit. The middle part of the curve, rates are still increasing, and I don't know if I want to tie it to the 5-year. Okay, so it's 1 basis point. That just could be random, but you really see it in the 2-year. And if we look at our slope, we're seeing the 2 to 10s are now inverted. The 5 to 10 is inverted, and we have dropping slope from the 2 to the 20, the 10 to the 30. But if you look at the 3-month to the 5-year, which is a good gauge of the profitability of consumer loans, and the 3 to the 10-year, which leans more towards corporate loans being the 5 to the 10 as well. These are typically put out as floating rate loans. So that it is a spread. It'll be a spread above a 5-year rate, a spread above a 10-year rate. That's still very steep, and I've drawn them in here. This is the 3-month. Here is the 5-year. Here is the 10-year. So you can still see that we have, if we're judging bank profitability on loans by this slope as opposed to a 2-year to a 10-year, which is inverted. So this is the one that we would pay attention to more. Now, when this becomes flat and this starts to inverse, when the 3-month to the 5-year, 3-month to the 10-year starts to invert, that becomes a problem. So all this talk about inverted yield curves, yeah, it is there, but for it to really cause, if we're going to be watching the 2 to 10, you really aren't going to get too concerned until you see like negative 100 basis points. Because that will work to begin to flatten the 3-month to 5-year and the 3-month to 10-year. But you're looking at about 200 basis points on that one. So as far as credit growth is concerned, we shouldn't see a problem. So let's look at credit growth. So we've got some charts coming up from Fred database, and we'll look at growth in consumer credit. We'll look at growth in corporate loans, and we'll see what's going on. Over the past week, the 30-year mortgage rate is now at 4.88. The week before, on Friday, it was 4.95. So this is down 7 basis points, which makes sense. The The 10-year has dropped 10 basis points, and mortgages are pegged to the 10-year. The 30-year dropped 16. If we're going to say that the 30-year mortgage rate is pegged more to the 30, it has dropped 16 basis points. The 10 years dropped 10. Mortgage rates are down 7. Okay, real yields and break-even rates. The big story is with the break-evens. Look at this. They've all moved down closer towards that 2% anchor, which the Fed would like to see, especially at the longer end. They've all given way. The 5-year down 30 basis points. Real yields higher from the 5 to the 10, lower from the 20 to the 30. Although these are small enough that I could say that's just, week-to-week noise perhaps. I don't know that there's too much intentionality in there, but there does seem to be intentionality in the 5-year. The data over the past week, if we're wondering, well, why are we having a decrease in the break-even rates? We would have to think that inflation expectations are giving way somewhat. Let's look at PCE, the core PCE from March 31st, year over year, came in at 5.4% versus an estimate of 5.5%. So 5.4 still elevated, but we still came in below the expectation. Well, that's a positive trend. This is even more interesting and exciting. Personal incomes month over month were up 0.5. The core PCE month over month was up 0.4. So income, month over month, incomes grew faster than the cost of living did. That is a good thing. If you contrast it to the month before, personal incomes were only up 0.1%, while core PCE was up 0.5%. Not a good trend. This is a very good trend. You got to give a check mark there. 5.4 coming in below the 5.5, even though it's elevated, came below expectations. Got to give a check mark there. We got another check mark coming up here. Payrolls up 431,000. More people have jobs. More people have jobs that are paying more, by the way. Average hourly earnings year over year were 5.6%. Compare that with the core PCE, which measures cost of living, not the price index. Cost of living up 5.4%. Average hourly earnings up 5.6%. That's positive. This came in below expectations, but there was a revision to the prior month of 95,000. So the combination of the two did beat expectations. We have 95,000 more than we had known before. And the participation rate also improved 0.1% up to 62.4%. And as far as prospects for more jobs not being created, jobs are created down here. Whenever somebody posts a job opening, it creates a job. This here really measures how many people have taken jobs. So are there jobs to take? 11.266 million job openings, which is greater than the number of unemployed people. And if you look at the number of people on continuing claims, it's like 1.4 million. You can cover that almost 7 times with the jobs that are available. Quits, 4.352 million. So quits are still over 4 million. People feel comfortable quitting one job, moving to another job, and usually those moves come with a pay bump. Otherwise, why would you go? You certainly wouldn't quit one job and take another job at a lower pay. Sure, anecdotally, there are probably people out there who say that job sucked, I'd rather get paid less and be happy. But overall, people usually quit one job to take another job that offers more money. So that is still elevated, which means there's still some wage pressure going on. So the combination of all of this, I think this is really good. 5.6 versus the 5.4 last week. I said that's what we wanted to see. We wanted to see that the growth rate in earnings was greater than the growth rate in the cost of living, and it is. That's a positive thing. Is that going to translate into actual spending? So we're going to look at the health of the consumer, and we're going to look at retail sales and see, are consumers still spending? And what do you think we'll see? Right? Let's handicap the Fed here. I've changed my probabilities a little bit. Next meeting is May 3rd with the May 3rd, 4th, with the 4th being the decision day. I'm still 0% on 0 basis point change. I don't think they're going to stand pat. They're going to make a move. Is it 25 or 50? I'm slowly leaning more to the 25 and not the 50. My argument for that one is there is still very much associated with inflation that higher interest rates are not going to fix. And one of them is still supply bottlenecks, especially with durable goods. It's simply just not going to be fixed with higher interest rates. So I'm sure the Fed recognizes that. I'm sure they recognize that they have to weigh two things: the perception of their willingness to fight inflation, along with the effectiveness of anything they do actually changing anything to do with inflation. So I think they're going to make moves, but I think they'll be window dressing moves, token moves. I don't know that they're going to be super aggressive. So I'm leaning more towards the 25 basis point rate hike right now. I'm sort of underweighting the 50 at 45%, leaning more towards the 25. For balance sheet reduction, I have it listed like this. If they're going to reduce the balance sheet using MBS only, I'd say there's a 70% probability that you would see mortgage-backed securities just being run off. And somebody had asked me, what does that mean, run off? MBS pays monthly. You receive a payment every month, and when you receive that monthly payment, it's going to be principal plus interest, because that's what mortgages do. Every time you make a payment on your mortgage, some of it is interest, some of it is principal. Well, these are mortgage-backed securities, which means every month investors receive their mortgage payment, some principal, some interest. Rolling it off means you simply just collect your payment, your principal, interest, and you do nothing with it. Maintaining the size of the balance sheet means every month when you receive principal and interest, you take the principal and you reinvest it. And that maintains the size of the balance sheet. So I think that they're going to work on MBS only. And I think there's a 70% probability if they go with a 25 basis point hike that they will then say, well, let's split the rate hike into two events. Number one, an actual rate hike, and number two, the equivalent of some type of rate hike by allowing the balance sheet to reduce, which reduces the amount of demand in the market for these bonds, which doesn't crowd out other investors. So that money then comes in that otherwise would have gone somewhere else to inflate asset prices. MBS only. Letting MBS roll off and U.S. Treasuries, I got it down to 20% if they're going to do a 25 basis point hike, and not reducing the balance sheet, but simply saying, okay, well, the principal received from MBS, let's roll them into USTs. In other words, let's get MBS off our balance sheet. Let's replace them with Treasuries, but let's not reduce the size. I got down at 10%. If, on the other hand, they do go 50 basis points to the 45. I've changed the rates here, the probabilities here. I think that they would then, I put 80%, that they would then roll their MBS to UST and not reduce the size of the balance sheet. I don't think that they would move 50 basis points and do balance sheet reduction at the same time. But I do think that they would move out of MBS and move it into UST. So every month when they receive their payments, whatever principal they get, they'd roll it into UST. Probably at the 10-year, because the mortgages are pegged to the 10-year. So if you roll them back into the 10-year, you can keep the 10-year low so that mortgage rates don't, explode upwards. Because when we saw the shape of the yield curve, it looks like this, and then it drops down to the 10 and then jumps up again to the 20. So there's something going on with the 10. Why is the 10 not up there? And if the mortgages are pegged to the 10, that's one way of tightening monetary policy while keeping mortgage rates, from going above 5% or 5.5 and really hurting the housing market. So I think that if they went the full 50, they'd be more apt to keep the balance sheet the same. Allowing roll-off of both MBS and U.S. Treasuries while raising 50 basis points. I don't think they're going to do that, because any balance sheet reduction begins to be another type of rate hike. It's quantitative tightening. It is another form of rate hike further down the yield curve rather than the short end. And MBS only, I put that at 20% if they're going to go with 50. But my base case right now is 25 and MBS only. We'll see how the data rolls out over the course of the month. I know that there's a lot of chatter right now pretty much everywhere that it's going to be 50. It's going to be 50. For the next two meetings, it's going to be 50, and that seems to be priced in. So I don't really base my probabilities based on what a whole bunch of people are saying. I hear what they're saying, but I base it on the data that comes out, and then I think, what would I do? What would I do knowing what I know? I know that some of this price pressure out there is supply, and there's nothing I can do about it by raising interest rates. So raising interest rates is not going to be effective, and it may actually do some harm. However, not raising interest rates might do harm by affecting the confidence that the market has in the central bank, in which case these inflation expectations may become unanchored and start going back up. This has gone in the right direction. We're talking it down. Good enough. Let's do something. Let's give them 25, but let's give them something over here. And the market's smart enough to figure out that we're really doing 50 basis points. It's just we're working on different parts of the curve to get it done. I'm thinking, that's kind of how I would think it through and how I would do it. So rather than listening to, it's going to be 50 basis points and jumping on that bandwagon, I'm just sort of saying, well, if it were me, what would I do? This is the way I would do it. So those are the probabilities that I'm placing on it right now. Okay. For the bulk of this video, I'm going to attempt to make the best bull case I can. And whenever you're in an asset that happens to be dropping in price, but you believe in this asset, what you should do as a sanity check is not look around for all the reasons why the price should go up. That's confirmation bias. But what you should do is sit down and make the bear case for that asset. The best bear case you can. Imagine that you have to do a presentation to a group of people, and your success in that presentation will be based on how much you can convince the people in that room that there is a bear case on this particular asset. So that's what I'm hoping to do here, is I'm going to try to convince you that there is a bull case, and that's the only way to do it right. If I can't, then there is no bull case. If I can't make the case, there is no bull case. Well, I can make the case. I can also make the bear case, which means right now I'm kind of on the fence because I can see both sides and I say, well, I see your point over there. And on the bear side, I see these points over here. Well, the big thing that's going to solve it for us is the earnings season. I think that's going to give us a clear picture. But just to say this time looks like this particular time in history, and here's what happened, I don't like those sort of things. So GDP, it drives everything. If we have very strong GDP growth, you will have very strong earnings growth. You will have very strong stock market. I don't know that there's been a time in history where the stock market has declined on very strong GDP growth. It is the big driver. So let's look at GDP, and these are the components: the consumer, investment, government spending, and your trade balance. Well, for the U.S., we know we have a trade deficit. Not really worth looking at that. Consumer is the big one. By far, and then investment is in there. Government does spend a lot, and they want to spend more. We never have to worry about governments wanting to spend money. They always want to spend money, so I'm just going to put a plus sign behind governments. They're not about to worry about the deficit. I don't see any sign at all in Canada or the U.S. that the government in charge is even slightly concerned about deficit spending or the level of debt. Not one iota. So I'm just going to put a plus sign in front of that, and that's it. The consumer is the big one. Well, here's retail sales. and here is retail sales. This is adjusted, see CPI adjusted, 82 to 84 CPI adjusted dollars. This is just millions of dollars seasonally adjusted. And you could see the difference here. I did January 20th to January 22 for both. If you don't adjust for CPI, if you don't adjust for inflation, up 30% over that 2-year period, but after adjustment, 13.7%. And it does have a very different slope than the slope that came before it. There is nothing about retail sales that shows me the consumer is concerned at this point in time. On a nominal basis, you would expect it to be the highest it's ever been, only because inflation is so high. On a real basis, it is not as high, but still, when you look at where pre-pandemic was, I mean, when you look at the difference between those two, it is significantly higher. So retail sales is not flashing anything that is causing any concern right now. If you follow GDP now, by the way, remember last week we looked, it was 0.9 because of the data last week and especially wage growth. GDP now is at 1.3 as of March 31st. So GDP now has increased to, this is real GDP, to 1.3 from 0.9 over the past week. So you could say that the past week was, I'm going to say it was bullish for GDP. These are bullish charts for GDP as well. We see that retail sales is growing in the right direction. It's strong. It hasn't turned over, at least not yet. But you're not going to know whether or not this is a top until you get more data, right? So we're going to keep our eye on the level of retail sales and follow that trend. This is retail trade again. This is nominal. Here we are up here. And down here is total consumer credit. Look at this recession here. Retail sales did not drop. Went right through this recession very nicely because consumer credit continued to expand. This was the Great Recession, which was a credit crisis. Consumer credit did fall off. We see a noticeable drop in consumer credit here, and you see a drop in retail sales here. This was pandemic related, but we don't really see very much credit change here. Just you couldn't go out and do any shopping at this point in time. And then here is consumer credit still expanding. And as consumer credit has expanded, every period of time that it's expanded, retail sales have expanded. We have one time where consumer credit did contract, retail sales contracted. So unless we think that there is some kind of consumer credit crunch coming up where the suppliers of consumer credit pull back, I don't think retail sales are going to pull back. Now, you may say, well, rising interest rates will do it. Well, let's go back to mid-2000. Let's go from 2005 onwards. Interest rates went all the way up to 5.25%. We are at 0.5%, and we are all in a big fit about going to 2%. This was 5.25%, maybe even 5.5. I think 5.25% retail sales and credit were still expanding. This was the credit crisis. There's the drop in retail sales. But for consumers, as long as they can access credit, it does not matter at what cost they can access credit, as long as they can spend. So because I don't see any credit contraction coming up on the part of the suppliers of credit, I think you're going to get something like this. Even if you get a recession, I still think you're going to get something like this and something like this. So I don't see any warning signs from consumer credit growth. All right, what are we looking at here? This is delinquency rate on credit card loans. This is our banks ranked first to 100th largest by size, and this is all commercial banks. Here's where we are. This is delinquency rates, 1.62%, 1.47%. Look at it in a historical perspective here. Never been lower. The consumer seems to be very healthy at this point. Even the period of time, going back into the 90s, we seem to have a channel in here between a little over, about 3.5%, all the way up to 5%. This was the credit crisis, 2008. And then we seem to have floated into a new regime here from 2012 onwards to 2019, and we're even below that at this point. And these are delinquencies. So even though consumer credit has been rising, delinquencies have actually been decreasing, leading into a recession. Look what happened here. See this rise, and same here. You see this rise into this recession. Over here we have a bit of a rise. Here as well you have a rise into it. I'm not seeing that at this point. So nothing here. When I get to delinquencies, I'm not seeing any warning signs that, yeah, they've taken a lot of credit on. That's why they spent a lot. That's why retail sales are so strong. But have a look at their payments. Those delinquencies are increasing, which means that kind of credit growth can't continue on. I'm not seeing that at all. Okay, this chart is commercial and industrial loans for all commercial banks, and we are way up here. And we seem to have different slopes on the chart in terms of the growth rate of loans over time. What I did was for this period of time, this was after 2000, somewhere around 2004, all the way to within the Great Recession. You can see the increase in loans here, and even after the recession, all I'm doing is I'm moving it over parallel, has the same growth rate. If we go back to 94, we have a much slower pace of growth in loans, and if I move it parallel at this end, notice it has pretty much the same slope. This is pre-pandemic to where we are now. I've basically taken out this level in here only because it probably has a whole bunch of pandemic-related loans in there, pandemic-related loans that might have been secured or guaranteed or in part partly financed by the government. So I just took that out and I said, well, let's go from something that just before the pandemic to where we are now, and let's just extrapolate a growth rate from there. The growth rate is 2.61% year over year. This growth rate here over this period of time was about 8.3% year over year. So yeah, much slower loan growth since coming out of the pandemic. But there are still pandemic-related factors in there that could be clouding the data, could be underestimating exactly what the true potential would be. So can't read too much into that. But what we're not seeing is this. We're not seeing a drop-off. This, again, I say we're just going to ignore this kind of jump up here because it could be government-related loans that are done through banks going on. We're sort of just looking at a continuation of what happened before to where we happen to be now. But March 27th, 2019, the balance, this is in billions of US dollars, 2,320. And March 23rd, 2022, 3 years later, we're at 2507. Okay, this is an interesting comparison, these two charts, that I think highlight a problem that almost all central banks have at this point. Our top panel is total vehicle sales. The bottom panel is domestic auto inventories. And we have this recession here in 2000, 2002. Notice that vehicle sales really weren't really not affected that much because this was a non-credit related recession. This was a credit related recession, so yeah, you see a big drop off here. And then from about mid 2014 onwards, the run rate here, 17.5 to 18 million vehicles a year. The last read on this was 14.482, and we're going to learn sometime this week that we're either at 12.7 or 13.2 on the latest monthly read, so it'll be down a little bit more from where we are. But have a look at inventories. Look at where they are, way down here. They're just, the company, like this is 65,000, by the way. That is an inventory of 65,000. So, even if you're going to sell 12.7 to 13.2 million cars for the year and you only have an inventory of 65,000, you're talking, you're measuring that inventory in single digit days before it's all gone. Car companies don't have a demand problem at this point. They have a supply issue. Higher rates aren't going to fix the supply issue. Prices are high, not because demand is high, but because supply is low. Now you may push back and say, but that means demand is higher than supply. When I say demand isn't high, it's not as if demand's way up here, that the market is demanding 21 million cars. Never been done before. 21 million cars. How are we going to get 21 million cars out if capacity is 17.5 to 18 million? That's way too much demand. But demand may be normal. It's just supply is not normal. While raising rates isn't going to do anything to lower prices because you have to raise the amount of supply. To destroy that much demand, you would have to raise rates significantly. We're at 0.5%. The thinking is, well, by the end of the year, we'll be closer to 2%. But if you go back to this period of time over here, remember, we were at 5.25%. Now, it wasn't higher rates that caused the drop-off in auto sales because consumers for the whole year ahead of that were accepting those higher rates anyways. Rates that were at least 400 or 500 basis points higher than where they are now. And they were accepting that. It was, the housing bubble crashing, all of the bad actions going on with mortgages at that time that really caused, that drop-off. It was the recession that broke the back of car sales, not higher interest rates. And I think that for this particular round, it'll be the same thing, that you can raise interest rates all you want. I don't think you're going to slow down auto sales. The supply issues will keep auto prices high for an extended period of time until those are solved. Once those are solved and everybody can get supply, then we'll get back to, you get employee pricing and this discount and that discount. You used to be able to walk into a car lot and get $10,000 to $15,000 discount right away just off the manufacturer's suggested retail price. That's gone now. So I don't see this, unless the Fed can actually cause a recession, I don't see these prices going away, which means I don't see a certain part of inflation going away unless you actually cause a recession, which means you're not going to have the soft landing. It's not going to be a matter of a few rate hikes, demand will pull back, and everything will be just fine. For there to be a soft landing, you've got to pull back demand where you can pull back demand by making the waiting lines shorter and increase supply. Hope that supply builds in and increases. So I used an analogy before of people waiting in line for a club, but let's say that you have a club here with a capacity of 300, but construction is going on that will raise that capacity to 400, but it's slow. And you have a lineup of 500 people, and it's a $20 cover charge. 500 people aren't going to fit in here. And as soon as this capacity is built, we can handle more. But right now, we got to do something. Let's raise the price to 25. You might get 100 people to leave the lineup, and you have 400. Still, it only holds 300. That to solve the real problem of too much demand, you have to get this supply online. That's where the auto industries are right now. They have the capacity to make more, they just don't have the supply to make more, as evidenced by this inventory level. Cars are, I think I read something this week that half the cars that land on the lot are sold within the first week of landing on the lot. In other words, if the dealership can put a car on the lot, it's going to sell. It's pretty much going to sell. So this is a tricky thing to take care of. I'm sure they're aware of that. I'm sure they're aware that there are these supply issues, that interest rates are going to do nothing to affect that. Which is why earlier when I looked at the probabilities, I showed you the probabilities, I'm overweight 25 basis points versus 50. They got to be seen as doing something, but 50 is not going to change anything. So why not go 25? And then why not give the market something on the balance sheet at the same time? Hopefully, as each month goes by, supply issues start improving and start to take some of this pressure off. When the car companies reported their numbers, their auto sales, GM was down, but they also reaffirmed their guidance for the year. They still said that they plan to have a better year than 2021. That they are seeing improvements in the supply chain, and they expect it to really improve in the second half of the year. And I think that the Fed will probably, align with that quite well. Not that they're paying attention to that, but I think they'll align to that. And I think their thinking is that some things are going to improve on their own in the second half. So let's not do a lot of damage right now. Let's do enough to get the market there. The market's already done the heavy lifting by getting rates up so high that even if we throw 25 out there, it's going to do no harm. I'm not sold on the 50 basis points. Even though I give it a 45%, I am overweight the 25%. And this is just evidence that, well, what are you going to do? Raising interest rates isn't going to create more semiconductors. Raising interest rates isn't going to create a larger labor force. Raising interest rates isn't going to do anything to suddenly create more aluminum or more copper or more steel in the world. These are supply issues. So that's it. So these two charts are vehicle miles traveled. This is the same thing down here, except I've just zoomed in on January 2014 to January 2022. And these are vehicle miles driven in the US. You can see the sawtooth pattern here. All the lows, all these low points here, these are all February's. If you get this chart up and you hover your mouse over that point, it'll tell you that we're in the month of February. And the peaks are either July or August peaks. Most of them are August, but every now and then you hit a July. So driving peaks in July or August and the bottoms out in February. And I calculated the average peak to trough, the February, from the average February to the peak summer month, whether it be July or August, at 27% more miles driven. So that means we're going into a season of increasing demand for gasoline. And we can see where prices are right now. So if we think prices are going to decrease, higher prices lead to demand destruction. That might, if it were July or August and that were going on, you would get this natural seasonal demand destruction by about 27%. But we're going to get increased demand by about that much on average. Where are we now? This was August of 2021, 296. And these are in millions of miles, 296,475 million. Versus 293 in the previous August. Pre-pandemic. So post-pandemic, the August post-pandemic for 2021, more miles driven than pre-pandemic. And all of these numbers were increasingly higher. This is the last number that we had for this series was January 2022, 240, 522. I tried to match it up with the same month, January 2019, 248, 942. I didn't go into this January and ask what the conditions were, the average temperature for the month versus what the conditions were here. You had an Omicron effect. Not everybody is back to work. A whole bunch of things here. So it's really noisy between these two. It's hard to compare those two. But we're not that far off. It isn't that bad. And that, that these were higher. But, January, February, March, especially in March, that's when you started to hit those really high prices for gasoline. So it's going to be interesting to watch this series to see whether or not we get past these lows, because these are continuously rising throughout. All of these are what they call monotonically increasing. Each one is higher than the previous one. So if you extrapolate out, we should we should see a bounce from March being above, we're going to get February. This is January. These are all February. So our February here we know is going to come in lower, and then we'll see what March comes in at. And we'll see whether or not higher prices does actually destroy demand. We hear a lot about that, demand destruction. At higher prices, people will demand less. But when I drive into the office, I go past 2 service stations pretty much at the same time. I see the same lineup of cars waiting to fill up. The roads are just as crowded as they've always been. I'm not sensing that there are fewer cars on the road. The highway takes me past the mall, and by the time I drive past the mall parking lot is full. It's full every day. I'm not seeing any demand destruction. And I think a lot of it has to do with credit. There is no credit destruction. So even though I don't have the money, I have my credit card. And as we saw, delinquencies aren't rising, so there must be affordability. We're seeing average wages now are increasing at a rate higher than the cost of living. So for the average consumer who is unaware of what these numbers are, most average consumers really don't know what average hourly earnings are up by. They don't really know what the participation rate. They're sort of agnostic to all of this. And because they don't know the data, they go on behaving the way that their income and their credit availability tell them that they can behave. And I'm not seeing any change in behavior. So it'll be interesting to see if the high gas prices has actually changed anybody's behavior. We'll return to vehicle miles driven as we get more data. Maybe in a couple of months we'll return to this to see if, has it done anything? I'm going to cycle through a number of charts that I have open at the top tabs here. This first one is unemployment, the unemployment rate. And we're way at this end of the chart over here at 3.6. It was lower just pre-pandemic. January 2020 was 3.5%. We've almost returned to that level. We can zoom in on that end part a little bit more. 3.6, and I think the low point we had was, there it is, January and February both came in at 3.5. And then we shut down the economy, and then we got it pretty much, the unemployment rate almost all the way back to where it was before, albeit at a lower participation rate. So we got to sort of take that factor in. Looking at personal incomes, let's zoom in on this as well. This is a pre-pandemic, February 19, 006. Again, that's in billions of dollars up here. We're at 21,153. So it has continued its upward march. So you have more people getting jobs every week, more job openings than there are unemployed people. For 2 weeks straight, we've seen initial jobless claims being super low. Wage increases now year over year that are exceeding or that are higher than the cost of living measured by the PCE. Growth in credit still occurring, no credit crisis. Retail sales still growing. Auto sales obviously are under pressure because there's a lack of supply, but all supply being made is being sold, as evidenced by almost no inventory. The consumer is not a problem. Let's have a look at businesses. This is United States bankruptcies going 2013, 14, 2016, 2012, 2016, 2018, 20. Look at this dropping right off. You go out 25 years, it's still low, the lowest it has been over the last 25 years. And if we take the maximum amount that they have all the way back to the early 80s, look how low that is here. And we've seen that loan growth, commercial loan growth, is still growing. Bankruptcies are really low. And the yield curve from the 3-month to the 5-year and the 3-month to the 10-year, which is what we would be paying attention to in terms of the profitability of loans, of 5-year loans and 10-year loans, is about 200 basis points. 200 basis points away from being flat. So the critical lending curve, the 3-month to the 5-year, 3-month to the 10-year, is nowhere near inversion. Bankruptcies are pretty much at an all-time low. Unemployment is nearly at an all-time low. Wages are pretty much near an all-time high. Aggregate incomes are at almost at an all-time high. Retail sales are hitting all-time highs. Miles driven, based on the peak summer driving season for August, was higher than pre-pandemic levels. I'm not seeing a problem with the consumer. And if you don't see a problem with the consumer and you have all of that horsepower with the consumer, I can't see a recession. I see GDP growth. And if I see GDP growth, you got to be bullish on the market, because nothing drives a market like GDP growth. It is the primary engine of growth in earnings. So if companies can maintain net margins at running at, what did we see last time, 12%, if they can maintain it at 12% and even push a little higher than 12%, yeah, you've got quite the bull case going on as well. Now, in preparing for this one over the course of the week, I watched a whole bunch of other commentators. They tend to talk more about technicals. That, on every market bottom, there's always been these very strong rallies. And that's what we just had. When they pick different times where you hit a market bottom and you had a strong rally and the market went on for 4 or 5 years to hit new highs. However, there's also lots of evidence showing that bear market rallies are very strong as well, but you never get to higher highs. So we had a nice big rally so far, but we're sitting below the highs that we had before. If this rally fades away and we start going down without hitting a newer high, technically, that is a bit of a problem. I'm not a big fan of the technicals, so I'm not really going to start putting these charts up and drawing lines and doing that kind of thing. I'm more interested in the fundamentals, which is a multiple of forward earnings. And because we're dealing with nominal earnings, it's hard to see how nominal earnings aren't going to be higher. If we adjust for inflation, maybe they won't be higher, but it's hard to see, based on the consumer, how they're not going to be higher. The big question, there are two of them, really, is what are net income margins going to be? And I think the better number to watch, actually, than net income margins is gross margins, because it's higher up on the income statement. Less manipulation can be done to the gross margin. The further down the income statement you go, the more accounting can help make your numbers, as opposed to actual results can make your numbers. So is it going to come in? Are they average across the S&P 500 going to come in at 12% or higher? And if there is margin contraction, is there going to be multiple contraction? And if there's multiple contraction, well, we're sitting at 20 times forward earnings, 19.5, 20 times forward earnings. The long-term average is 17. If you're expecting 225 on earnings, that's 675 points overvalued. We'll look at a chart, an S&P chart, and we'll draw some fundamental levels on there shortly. But nothing that I've looked at, I shouldn't say nothing. I'm really just trying to make the bull case right now, and there's a lot to be bullish about based on what I've shown you. There's a lot here. Next week I will make the bear case, and we'll see how we feel after that. The bear case has got a bunch of the obvious things in there, a bunch of the obvious risk factors, and a few other things, but I don't want to get too far ahead of myself. The goal here was to really try to make the bull case, because I'm skeptical of this rally, and if I'm skeptical, I want to make sure that I'm not missing anything. And going over the reasons why I'm bearish are not going to do it, because I already know why. I already know why I'm skeptical of this rally. I already know why I feel a little suspicious. By going over this, it gives me that that clarity of like, well, okay, that's a good point, and okay, I see the point over here, and okay, there's unemployment and credit growth and retail sales and wage growth. Okay, there is a bull case here, so I can't say that this whole rally is being, nonsense. However, let's look at something else. Now remember, earlier in the video I said, as a general rule for institutional investors, it is I shouldn't say a general rule, it's almost a law. Money has to go somewhere. So if we say, we know rates are rising, bonds are going to sell off, you may as well get out of the way of bonds. Well, where are you going to go? That's your next decision. So if the place you're going to go is worse than the place you are, you may as well just stay where you are. You'll lose less, but at least you'll have some income because of the coupon payment. You'll get some income associated with that. Let's do a little bit of reading here, and this is Refinitiv's data, U.S. weekly fund flows. First paragraph here. Investors were overall net redeemers of fund assets in the first week. In 3, withdrawing a net $20.2 billion of the week ended March 9th. That's a net. Fund investors were net purchasers of equity funds, plus $12.5 billion, while being net redeemers of money market funds, taxable bond funds, and tax-exempt fixed income funds. So look at, you see money, 26.2 coming out of money market funds, 5.8 coming out of taxable bond funds, and $500 million, a little more than $500 million out of tax exempt, with 12.5 going into equities. Money has to go somewhere. It has to go somewhere. As a retail investor, that's not always true. If we take money out of something, it can simply just go back into our bank account, or it could just sit there. And we wouldn't even say that that's sitting in cash, because cash is usually represented by short-term securities, 90-day securities that turn over, 30-day or 90-day securities. It's really just, sitting there in a pile of money. Now, I wouldn't even call it cash. Cash is an investment. If you just got money in your account earning nothing, it's just a pile of money. So retail investors don't think that way. Institutional investors do. If I take money out of this, where's it going to go? Well, if it's going to go into equities, pick a continent. Europe, is the next big liquid continent that you would put it in. Well, you're probably not going to go to Europe, because you're getting yourself closer to the war zone, and there's going to be more retail spillout because of that in Europe. So if money is leaving funds, and this is just one country, think about it globally. Bonds are decreasing, government bonds are decreasing in price globally. That money's got to go somewhere. It's got to go somewhere. So it's going to go to the least painful place. If it can't find a joyful place, it'll go to the least painful place. And if you think about where you want to be in 3 years or 5 years, I don't know that you want to be in bonds, but I think you want to be in equities, even if there's going to be rocky road ahead for the next year. If you think out 5 years, certainly you'd want to be in equities, and I think the U.S. is in a really good position to weather any recession that would come up, whether there is or is not going to be one. I don't think that 2 to 10 inversion of 6 basis points is telling us anything at this point. I think that if you want to watch something, watch the 3-month to 5-year, 3-month to 10-year. As I've been informed, it is the more relevant curve that banks would be looking at. So there we go. And a couple of weeks ago, I said, I think it's just, this rally is hard to explain. It's probably that, well, look, I can't be in bonds. I know I'm going to lose money in bonds, so I may as well move into equities and hope for the best. And these fund flows are sort of supporting that, these are all negative, money market, Fixed income, all negative, but positive into equity funds. Okay, here is SPY, April 27th to April 1st. Currently sitting at 20.1 times earnings. The current consensus EPS 225.5. This is from S&P Global's latest spreadsheet from March 31st. Hitting a new high would put us above 21.3 times forward earnings if forward earnings stay at 225.5. And to hit new lows or to make a new low, we would have to be below 18.2 times this earnings amount. I think the important level to watch now is 462.50, which was the last high of this particular rally. That if you can, even with this pullback late in the week, if you can then rally and begin finishing above 462.50, then this rally is still in play. There's a long way down, so I don't know that I'm going to see too many signals on the way down. Next week, we get the Fed minutes. So that will begin to give us some clarity into what we think they may do next. But I don't know that it's going to give us anything more than we've already heard in the press conference. So I'm not sure that that's going to be a big market mover. And I didn't see, there are some reports next week on components of GDP, durable goods, things like that. But I didn't see anything significant that I would be really watching. We got factory orders on Monday. Tuesday, balance of trade. That's just never really that important for the U.S. Also on Tuesday at 10, ISM non-manufacturing. That'll give us our services, growth in services. That, I think, might be interesting because there is some belief that, listen, if you can't get cars, if you can't get fridges, if you can't get big durable goods because there's a shortage of parts, that money is still going to be spent because consumers still want to spend money. They're more likely to spend it on services. If they can't get the goods they want, they'll spend it on services. So if I can't get a new vehicle, I'm going to have my old vehicle repaired. And that would count as a service. So that we should see, if we see ISM non-manufacturing PMI come in above 58, which is the forecast, that's another indication that consumers are absolutely willing to spend, and they'll buy anything they can. If they can't spend money on what they want, they'll just go to the next thing on their list. Lots of Fed speak next week. Brainerd, Kashkari, Williams, there's quite a bit. Harker, quite a bit as well. April 6th, we get mortgage applications. Let's see what happens. It'll be interesting to see if, and also the 30-year mortgage rate, whatever the 30-year mortgage rate is, they'll be printing that, seeing if that comes in lower than the 4.88 we've already seen earlier. And then FOMC minutes are Wednesday at 2 o'clock. Then Thursday you have the usual, the continuing jobless claims, initial jobless claims. I don't know that there's much that's going to move the market on that. Fed Bullard's speech, Bostic, Evans, Williams, whole bunch of Fed talk that day. And that pretty much is it. The big one is FOMC minutes. I don't know that we're going to get too much out of that. I'd be looking at ISM, non-manufacturing as well. If that comes in above 58.5, I don't really see why the market would react negatively to that. So, if it comes in strong, I think that's the tone. The Fed speak this week, I don't know we're going to get anything new on that other than just a reiteration of, yeah, we'll move 50 if we need to move 50. I think you'll hear a little bit of that, or some of them saying, yes, I would support 50 if 50 was tabled, but we already know that. So how do we play this week? This is a tough one. I don't know that I want to do too much because I don't have enough clarity right now. I'm at that indecision point. I managed to roll up my options on the S&P to cover off some of the calls I have. So I'm still slightly net negative delta on the S&P. Not a lot, but slightly. I don't know that I want to lean any one particular way at this point. And that is a decision in itself. It is okay to say, I don't know, so I'm not going to do anything. What I am going to do is I'm going to look for companies that have, for now, have pricing power, very good cash flow, strong balance sheets, that if I need to go somewhere for safety, that's where I'm going to go, because money has to go somewhere. And you may say, yeah, but my money doesn't have to go somewhere. I get that. But other people's money has to go somewhere, and they're going to be looking for the same things, that if they need to go somewhere, that's where they're going to head to. So for the week coming up, it's going to be a lot of sitting on my hands and research when it comes to what positions I want to take on the market. And it's a matter of looking at interesting stocks that I want to put on a watch list, that I say, I don't mind being in these. The Canadian dollar is still elevated and has been showing strength. I don't know that I want to leave the Canadian dollar. The Bank of Canada meets before the Fed meets, and the Bank of Canada, I believe, will go 50 basis points because the Bank of Canada governor is a little more hawkish in both rhetoric and action than the U.S. central banker is. So I do think that you'll get 50 basis points, and if you do, I still think you have maybe up to 82 cents on the Canadian dollar. We're sitting just around the 80-cent mark, a little over 80 cents. I think you have probably not a little over 80 cents, maybe just at 80 cents. Let me have a quick look here at where it's sitting. It's straddling 80 cents on the bid and the ask on the futures. We're just a little over 125 on the spot, 125.16, which would put it just slightly under 80 cents. I think you have 81, 82. I think 81 is a fair near-term target, with 82 probably being where I think we could get to in the next 3-4 weeks. If the Bank of Canada does make its move, which I think it will. I think the Canadian dollar will be strong. I see no reason to leave that. I'm really not going to get much clarity until earnings. We're in April now, so earnings will start in about 2 weeks. You'll have a nice week full of earnings, and then every week after that, you'll have some 60 to 80 components reporting earnings for a period of time. And margins are going to be a big thing, especially gross margins. That's going to be a big thing. And how many are beating their estimates? How are they doing on revenues? I think revenues are going to be higher year over year only because inflation is higher. So because they're reporting in nominal dollars, I don't think that's going to be a consideration. But expenses are in nominal dollars as well, so margins are as real as you can get. I mean, if your revenues are up because of inflation and your costs are up because of inflation, do you have the same margins? Margins, negate the two altogether, because your numerator and denominator are both nominal rates. You'll end up with a real ratio, or a real percentage, which is the margin. So margins, I think, will be watched. And, I think you only need the first week to set the tone. I think that will set the tone for how the market will respond throughout April before the Fed meeting coming up. So this week, action-wise, I think it would be wise to say, unless you need to get out of some positions or to rebalance, if you're looking for opportunity, I would say your opportunity lies in patience. Let's just wait to see what happens. Unless something big happens. If something big happens, you don't say, well, somebody set off a nuclear bomb, but I'm waiting for earnings. No, you're going to respond to that right away. But I don't see much that can move things at this point. I think all eyes are on earnings, and that's where they're going to stay until we start to get some actual data. But if the margins come in solid and the numbers come in good, I don't know what could take this market down internally after that. So I think that's the next big game. April is earnings month, and I think that's probably for this month the only game on the street. I think we're where inflation talked out, where central bank talked out, where Ukrainian war talked out. It's earnings. That's the big one. Okay, I'll wrap it there for the week.